Good morning. Welcome to Stock Market Today. It's Thursday, February 13th, 2020. I am Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at Dan_Russo_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email. Daily stock ideas for you to consider. Hits your inbox every trading day before the market opens. And before we go further, just a quick programming note. I have a rare day off tomorrow, so there will not be a show. And then next Tuesday and Wednesday, I am in New York City for a workshop. So I will be back to you next Thursday. Let's dive into it now. U.S. equities ended Wednesday at another record high. Energy, tech, and consumer discretionary were the leaders. Consumer staples was the only sector to close lower on the day. Treasuries were weaker with the curve steepening. The dollar was stronger versus both the yen and the euro. Gold was flat on the day. WTI crude rallied up 2.5%. But as we get to the desk this morning, resurfacing fears around coronavirus send the S&P futures down by 70 basis points. Asian markets were mostly lower overnight with weakness led by mainland China. European markets are declining as well. Treasuries are stronger across the curve in a flight to safety. The dollar is weaker versus the yen, but little changed against the euro. Gold also benefiting from the safety bid, up 40 basis points, and WTI crude coming under renewed pressure, down about 0.5% after gaining 2.5% yesterday. So diving in on the structure of the S&P 500, new highs, but those renewed fears have us trading lower here this morning. Now, support is still in that range that we were highlighting yesterday between 3250 and 3300, and I've drawn those lines on the chart. We're still looking for a resistance level to form. Maybe today is the day. The RSI is in bullish ranges, but that divergence is still in play. And today is really going to be a day about divergences because we're going to touch on that a little bit later in the show. But here's the new high for the S&P, unconfirmed by RSI. So something to keep an eye on. Chaikin money flow does remain bullish. And I guess if we wanted to get technical about it, we could say that there's a divergence here as well. Divergences are a warning sign, a yellow flag, if you will. Maybe calibrate how aggressive you want to be with new ideas is how I like to think about it. As always, it's going to be the breakdowns through key support levels that change the view from a trend perspective. So while we're still looking for resistance to form, we're mindful of the divergences and highlighting 3250 to 3300 as the key support levels to watch in the near term. Turning now to our market in a minute. What are we writing about today? Well, new highs for the major averages in the U.S. as global equities also continue to trade higher. Obviously, that's going to come under pressure here today as well. Breadth divergences, however, have also caught our attention. So we've been talking about the RSI divergence on the major indices. Now we're going to start to look at breadth divergences on the S&P 500. Also, we're wondering, is there further downside in E&P names? That's exploration and production within the energy complex. And as we said, futures point to a lower open here today. But first, a recap of yesterday. From a power bar perspective for the major indices, Dow adds 95 basis points, 8-6, bulls to bears. S&P 500, that ratio strengthened yesterday after it rallied 65 basis points. NASDAQ, an outperformer, 35-3, bulls to bears there. Small caps are an inline performer, 520 to 254 there, but still underperforming on a relative basis over the past 6 months. Bonds downtick, sending yields higher. But bonds are rallying here this morning, as we said. And comm services was a strong group yesterday, up 1.3%. And remember, this is one of the areas of the market where we've been highlighting it, becoming increasingly bullish on that group over the past few weeks. 7 bulls to 1 bear if you drill down on the XLC, the comm services ETF. So according to the Chaikin Power Bar, small cap stocks and large cap stocks are bullish. Major indexes across the board are mixed. Let's hit our stock of the day now. Remember, the stock of the day is auto-generated based on the power gauge rating and its preferred bank. No surprise, comes from the banks group. Closed at 62.75, down 11 basis points yesterday. Has a very bullish Chaikin power gauge rating due to very strong earnings performance, very strong technicals, and attractive financial metrics. So when we roll up the 20 factors, 5 in each of these 4 categories, we come out with that very bullish rating for a stock that's in a strong trend above this rising long-term trend line. And in a strong industry group, from a power bar perspective, the banks remain strong. What I see here is a stock that's very bullish, outperforming the market with bullish money flow. Overbought, oversold indicator, middle of the range here as the stock consolidates. Now, what I would say is, with a flight to safety, lending a bit to bonds, sending yields lower, I wouldn't be surprised to see financials, especially banks, under pressure today. But I think that this one is one to keep on a watch list within the banks group. right? It's a solid setup here from a type of stock we want to own. Very bullish, outperforming, bullish money flow, strong industry group. It's really just a function of the timing, right? Overbought, oversold indicator, middle of the range. Banks likely to come under pressure today. I think you want to add PFBC to a bullish watch list. Watch how this consolidation plays out, and then set up your opportunity. But never like to waste an opportunity to analyze a stock. There's always something you can do with it. You can either put the trade on, or you can add it to a watch list for further analysis. And that's what I think we should be doing here today with Preferred Bank, adding PFBC to a bullish watch list here this morning. Turning now to our sector tracker, looking at the movement of the major sectors over the last 5 days. And there's real estate continuing to be at the top of the list. There definitely does seem to be a similar dynamic playing out here in the market through the first month and a half of the year that we saw in 2019. And that's growth and tech outperforming, while at the same time, the defensive areas of the market, like REITs and utilities, right, the bond proxies, also outperforming. I would add comms to that mix because comms has a mix of both offense and defense, right? After the reconstitution of that sector, you still have the traditional communications names in there, names like Verizon, AT&T, your defensive type stocks, but you also have names like Facebook in there and the video game stocks. So you got a nice mix of offense and defense, and that does seem to be the theme in the early goings of 2020. Discretionary tech industrials round out the top of the list. Healthcare, utilities, staples, middle of the road, fins, energy, and materials at the bottom of the list. And as I said, I wouldn't be surprised to see the financials come under pressure here today with rates moving lower once again. Energy just continues to be an area of the market that we want no part of. And materials, same type situation there, right? Group fundamentally doesn't look great, underperforming the market, just not an area where we want to be focused for bullish ideas at the moment. Turning to our industry in focus, NYSE Tech Services, which over the past 6 months has outperformed the S&P 500 by nearly 10%. And the power bar ratio, which measures future potential, is very strong. 19 bullish or very bullish stocks for only zero, count them zero, bearish stocks. Currently ranked number one of 21 subsectors, having moved up one slot over the past week. Some of the indicative names there, Intel, Micron, and Microsoft, all with very bullish Chaikin Power Gauge ratings, right? So we talked about what's going on in the market, tech outperforming along with the defensives. Well, this certainly plays on that theme. The question is it likely to continue? And we think that it is. Take a look at a name like Intel here. Now, again, futures are under pressure this morning. So I do think it makes sense to be more selective. But look at Intel here. Very bullish stock, strong trend above the trend line, strong industry groups. We've been talking about semiconductors for a long time now as a leading area of the market. Following an earnings-induced gap higher, Intel is consolidating above the breakout level. So we have a very bullish stock that is outperforming the market with bullish money flow. Overbought, oversold indicator now starting to move higher after failing to reach an oversold condition. That tells you that there's some momentum behind the move higher. So what I like to do in these situations is you can look at it a couple of different ways. First off, Intel is certainly the type of name we want to consider owning. You can buy a breakout through these highs. You can buy a pullback back into the lower end of the range here, or you can wait for an oversold condition. But it's really up to you. How aggressive do you want to be in the marketplace, right? No one says you have to buy your entire position right now. You can buy a portion of what you would normally buy and watch how this consolidation plays out. Either way, I think Intel is a compelling name on the long side of the portfolio. Taking a look at what's trending now. Yesterday's S&P 500 movers and shakers, IPG, EPS and sales growth sent that stock higher by 7.5% following their report. Anthem, no real company specific news, but I will note that healthcare services was an outperforming area of the market yesterday. Anthem part of that group. Gap, soft lines outperformed yesterday. Didn't see anything company specific on Gap, but that stock rallied by 4.7%. Humana falls into the same category as Anthem, part of the healthcare services group. Both of those stocks have very bullish ratings. Healthcare services is an area of the market where we have been writing about a lot in our notes and talking to clients. So continues to be good. But remember what I said leading into the election, wouldn't be surprised to see volatility within the healthcare space, especially as we see, as we track how Bernie Sanders is doing in the primaries. Hess rallied with crude oil up 4.6% yesterday. On the loser side of the board, Western Union, their earnings miss sent the stock lower by nearly 7.5%. Abiomed caught a downgrade at Morgan Stanley that took 5% out of that stock. AMCR, we don't have a rating on that one. They did announce earnings. Stock down 4.5%. And as we come in today, I see that there's actually one upgrade, one downgrade. Cerner, CERN, they lost Advent Health, and that's weighed on the stock. They announced that. It was announced a couple of days ago. Stock down 4.5% yesterday, but I will note that UBS is out defending the stock in a research note. Finally, TAP, Molson Coors, their EBITDA guidance disappointed. Investors took 4.4% out of that stock yesterday. So we said it's going to be a day of divergences. We've talked about the RSI divergences. That's momentum. Now look at breadth, right? Percentage of stocks in the S&P 500 that are currently trading above their 200-day moving average. It's still healthy at 80%, right? Don't get me wrong there. But listen, look what's happening here. As the S&P 500 trades at new highs, we've not made a new high on this breadth metric relative to what we saw earlier this year. Right, so that's another negative divergence. It's something to keep an eye on. It's something to be aware of. It's a bit of a yellow flag in the marketplace. It's not a sell signal. Right? It's hard to get timing right, and it could ultimately resolve itself. But if I'm thinking about looking for new ideas within the market, I really want to become more selective because these breadth divergences do have our attention. Same can be said for the intermediate term time frame, right? Percentage of stocks above their 50-day moving average, still healthy, right? Above 60% is healthy. We're at 69%. But again, that divergence is in play. S&P 500 making a new high. These metrics have yet to make new highs relative to what we saw earlier in the year. So just something to keep an eye on. Now, we don't show it here, but the same is actually true on a shorter term time frame as well. The percentage of stocks in the S&P 500 currently above their 20-day moving average has also diverged. Now, it's a bit of a mixed message, I understand, because it's still a healthy majority of stocks, but these divergences just say, look, become a bit more selective with your ideas, right? Markets had a nice run. Futures are trading lower this morning, right? There's no rule that says you have to trade, right? You can become more selective. And as always, manage your risk, right? You should always know where you're getting out before you get in, right? Before you hit that button to buy a stock, you should hopefully know where you're getting out if you're wrong. And you should have calibrated your position sizing accordingly based on the risk that you're taking. So just something to keep an eye on. We're watching these divergences extremely closely. They certainly have our attention in the here and now. Global markets move higher, but still lag the US, right? We always like to see what's going on around the world to get a sense for the strength of equities as an asset class. And here's the iShares MSCI ACWI ex-US fund. So, global markets outside of the US. Coronavirus fears pull back to test this support zone between $47 and $48 and a subsequent rally. Notice that the RSI never became oversold on this pullback. So that's an encouraging sign, but we're not out of the woods yet, right? We want to see this indicator quickly get back into bullish ranges, and it appears to be struggling. Wouldn't be surprised to see this group under pressure here today with renewed fears, news out of China as it relates to the coronavirus. So something to just be aware of. This chart actually, to me, looks a lot like the chart of the Russell 2000. If you received my note today, we're highlighting the IWM in our market section. And what should jump out at you is that while the S&P 500, the Nasdaq, the Dow are all trading up here, they're all trading at new highs. Russell 2000 and this group of global stocks, not yet trading at new highs. So the consolidation is still underway. Watch those support levels closely. And then finally, on a relative basis, if you're thinking about where to allocate and how you should be sizing your allocation, we think it still makes sense to have an overweight allocation to the U.S. within the equity space. I understand some investors like to run diversified portfolios globally, but I think your overweight should be the U.S., and this line tells that story. Clear downtrend, now have broken support and heading lower for ACWI ex-US relative to the S&P 500. Finally, we're asking the question, is there further downside in the E&P stocks? We think there is. XOP, Oil and Gas Exploration and Production ETF, after consolidating, fresh breakdown, remaining below the breakdown level, below the 200-day moving average, confirmed by momentum, and continues to underperform the market. This is a bearish group at Chaikin Analytics. That's going to wrap us up for today. Head over to chaikinanalytics.com/test drive to sign up for a free 14-day trial. I'll see you in a week.